Hello, welcome to the First Principles channel, a channel that is dedicated to helping you understand different concepts that will help you get better with your life and live the life of freedom. In today's episode, we're going to talk about the broken wing butterfly options trading strategy. If you've been following this channel, you will notice that a lot of emphasis has been focused on the options trading as a way to generate income for yourself. And we're looking at different opportunities here where we can use options as a tool to create regular streams of income for yourselves. The broken wing butterfly options trading strategy is a simple but very productive and profitable method of trading options to bring you regular streams of income. And if you're patient enough, you will see that this is a useful strategy that you can deploy in ensuring that you're increasing your probability of profitability with your options trades. All right, let's get it. As always, before we proceed, I'd like to encourage you, if you haven't done so already, to subscribe to the channel. There's lots of content that helps to simplify concepts that can actually lead to a life of freedom for you. And so you want to be part of this channel. And while you're subscribing, please hit that notification icon so that you are one of those who will see new videos as they are uploaded onto this channel. And on the left of the screen, you can see the other ways you can interact via Twitter and Instagram. There's lots of stuff going on there as well. And if you enjoy this video, please do us a favor, like and share on your social feed so that someone who might benefit from watching this video will also see it on your feed, and they will get to derive the benefits and the message that is being passed across on this channel. Cool. Let's talk about the broken wings options trading strategy. So before we go into discovering what the broken wings butterfly options trading strategy is, let's do a quick refresher on what options are. And if you have listened to previous episodes on this channel, you probably know what options are. And so you might want to skip this part, but I guarantee you it will go by very fast, and we will get back to talking about the broken wings butterfly options trading strategy. It's quite a mouthful. So let's talk about options. Options are contracts that give you the right, but not the obligation, to buy or sell multiples of 100 units of a stock at a set price on a predetermined date in the future. And now we're going to look at the two types of options contracts that there are that you can trade in the options chain. So one option contract that you can get into is called the put. When you sell a put contract, you're committing to buy multiples of 100 units of a stock at a predetermined future date and at a certain price. And for agreeing to buy that stock at that price on that date, you will get paid a premium for being the seller of the put contract on the date you go into the contract. So to illustrate, Microsoft was trading at $282.43 on the 4th of August 2022. You're happy to buy Microsoft shares at $244. So what that means is you can sell a put contract that will expire on the 26th of August 2022, and that put contract will guarantee you the fact that you buy Microsoft at $244. Now what it means is if the price of Microsoft falls below $244 on the 26th of August 2022, you will pay $244 on that date to buy Microsoft shares. If the price of Microsoft shares is above $244 on 26th of August 2022, there is no point that you're buying those shares because it's of no value to sell those shares to you. And so the options contract will expire worthless. But for agreeing to go into such a contract on the 4th of August 2022, you get paid a premium of 44 cents per share, which translates into $44 in premium that you will receive. But you will also be required to commit $24,400 so that if for any reason the price of Microsoft shares falls below $244 within the period of the contract, you have to pay to buy those shares at that price. Does that make sense so far? Let's break it down even further. So we're talking about getting into an options contract for Microsoft shares at $244. So fast forward to the 26th of August 2022. If Microsoft is trading above $244, the put contract expires. You get to keep the $44 that you were paid on the 4th of August 2022 and your $24,400 that you committed as like a security to buy the shares if the price went below the $244 is released back to you. So you come out of such an options contract with $24,400 and $244 in total of cash that comes back to you, and so you've made a profit of $244. Now the flip side to that coin is Microsoft ends up trading below $244 on the 26th of August 2022. You still get to keep the $44 that was paid to you as premium on the 4th of August, but you now have to buy Microsoft at $244. And so you have to cough out the $24,400 that you committed to buy the 100 units of Microsoft. You could still see it as a win situation because remember, you didn't mind buying Microsoft at that $244 price point. So it means that somebody is paying you a premium to buy Microsoft at the price that you wanted to buy it anyway. And this put method of buying or trading options has actually been a popular way that people like Warren Buffett, one of the biggest investors and most successful investors of all time, uses to buy shares that they would have bought anyway. So they don't go into the market buying shares at the market rate. They determine what price they're willing to buy those shares, and they sell put contracts to get paid a premium to buy the shares at the price that they were going to buy it. So that's put contract in summary. Now let's talk about call. So what is a call contract? When you sell a call contract, you're committing to sell multiples of 100 units of a stock which you already own at a predetermined future date and at a certain price. Let's illustrate again with the Microsoft shares. So let's say you have 100 units of Microsoft shares that you bought a long time ago. Again, we're back to the 4th of August 2022. You're happy to sell your Microsoft shares at $295, assuming you bought it less than that price. And you're happy to sell if the price hits $295 on the 26th of August 2022. So what can you do? You can sell a call contract for Microsoft that will expire on the 26th of August 2022. And for selling that call contract, you get paid a premium of $2.08 per share. This will translate to a total premium of $208. Now let's see what kind of scenarios could play out on the 26th of August 2022 and how that impacts your call contract account. So assuming you bought Microsoft at $282.43 per share on the 4th of August, and you bought 100 units of Microsoft, and you then sell the 295 call contract that expires on the 26th of August 2022, two things could happen. One, Microsoft is trading below $295 on the 26th of August 2022. Your call contract will expire. You will get paid, and you will keep the money you were paid on the 4th of August. That's the $208. You still own 100 units of Microsoft shares, and you can sell another call contract for those shares that you own, because it doesn't make sense for somebody to come and buy Microsoft shares from you at $295 when they can go to the open market to buy it for less. So that's why the call contract expires and you get to keep your $208 premium. The flip side to that coin is Microsoft is trading above $295. This is the reason why somebody will buy a call contract from you. When that happens, or if that happens, the 100 units of Microsoft that you have will automatically be sold to the buyer of the call contract at $295. So you don't get to sell it at the market price because you've already sold a call contract. And that means that if you bought Microsoft at $282.43, your total profit on the trade will be the 295 minus the 282.43 that you bought times 100 units, which is over $1,000, and then the $208 you got paid as a premium on the 4th of August combined, and your total profit on the trade is $1,465. If you don't understand what I've explained in the last couple of minutes, please leave a comment below and I'll be sure to get in touch with you, and maybe we can arrange a one-to-one for me to break it down further. In this video, we will show an example when we talk about the broken wing butterfly of how you can sell, well, mostly put contracts, but how you can sell options contracts. The beauty of options, though, is you can actually combine different types of contracts. So you can sell a put at one price and buy a put another price, or you can sell a put at one expiry date and buy another put at another expiry date. And these combinations of options contracts is what is called options trading strategy. Some people do these combinations of options contracts to reduce the amount of capital that they need to commit into a transaction, increase the probability of profitability, and this is really important, as we will see when we talk about the broken wings butterfly options trading strategy. Other people sell combinations of options contracts to reduce the risk of loss making, and managing risk is really important when you go into a trade. And other people do this to increase the profit potential if they know the direction, or they think they understand the direction of a stock price. So if they think that the stock is moving up, then they can enter into a combination of options trading contracts that helps them to maximize their profit, instead of just buying the stock at a certain price and selling at a different higher price. Using options is a fantastic way to increase your profit potential when you have an idea that the price of a stock is going up. Same principle can be applied to when you have an idea that the price of a stock is going down. You can use options trading strategies to also make money irrespective of the direction of the travel of that stock price. Now, let's see how this can work. So for those who have been waiting to get to this point, thank you for your patience. We're finally here. We're going to talk about the broken wing butterfly options trading strategy. It was important to go into the basics of options for the benefit of those who don't understand what options are, so that from here on it becomes easy to understand what this trading strategy does. As we've mentioned, we can combine options contracts to help us to achieve different objectives. With the broken wing butterfly options trading strategy, it is usually best applied to trading options on ETFs, a classic example being the S&P 500 ETF. It is also used to reduce the required trading capital while ensuring that you increase the probability of profitability of the trade. And if you're increasing the probability of profitability, then you're able to reduce the risk of a loss. And it's also useful when you have an idea of what direction the stock is trading, or maybe even how far the stock can fall and you're still able to make money. And we will see this explained very well when we go into an example trade using the broken wing butterfly options trading strategy. So what is the broken wing butterfly trading strategy? It's quite simple. All you're doing is combining 3 put contracts into one. Your ideal asset that you want to trade on is the S&P 500. Your ideal expiration date for the contract is 5 to 10 days after the date of your entering into the contract. And the trade combinations are as follows. So first, you want to sell 2 contracts at a price point that is at the 10 delta. So options have what are called option Greeks. We're not going to go into that, but when we go into the example, we will show you how to identify what the 10 delta is, and this is critical to this trade. So you sell 2 put contracts at the price point that matches the 10 delta or thereabouts. Then you buy a put contract that is either 1 unit to 5 units above the price point that you sold the 2 put contracts on, and then you buy another put contract at a price point such that you will be credited about 10 US cents per ETF share, which means when you multiply that by 100, you're going to get about $10 credited into your account. You want to ensure that the probability of profit for this transaction that you're going to get into will be above 92% on the trade. So we're going to look at the S&P 500 ETF, SPY, and the last trade was at 427.10. And when we look at the trend, we can see that the S&P has come down and seems to be heading back up. We hope that is the case because this will be useful for this trade. Now, let's go into Tastyworks, which is the platform we're going to use to see how this broken wing options trading butterfly strategy will work. Okay, so now we're going to try and see what is the best way to execute this trade well on Tastyworks platform. So we're trading SPY, which is the SP 500 ETF, and that is what we're going to use to try this broken wing butterfly trading strategy. So we go into the options chain and we look for an expiration date between 5 to 10 days away. So we will pick the one that is 9 days away. So let's pick that one, which is August 22. And we're looking for a contract that is 10 delta, if we remember. So that's our starting point, 10 delta. So let's click. So here we're at delta 22.02. So let's keep looking for the strike that gives us the 10 delta. That's it. So the 10 delta for the August 22 expiration date is $413. So what we want to do is sell 2 of these put contracts. So there we have, we've got 2 put contracts that will expire on the 22nd of August, and the price point is 413. Now, the next leg of the transaction, what we said, we want to buy a put contract that is between 1 and 5 points above the price point where the 10 delta is. So let's go one step above and we click on the ask, which means we're buying. Now it's default here to 2, so what we want to do is select that and reduce the quantity to 1. So now we see here that we're looking at a credit of 58 cents per contract. Now we said we wanted a net credit of about 10 cents. So we will now go down and look for a put contract that we can buy such that when we buy it, the net credit will be about 10 cents. So there is the 410, which is trading at 46. So we buy that, which reduces our net credit to 13 cents. This trade where we sell 2 contracts of the 413 put that will expire on the 22nd of August, and we buy 1 contract of the strike price above it, which is 414, and we then buy another 1 contract at 410, we will receive a net credit immediately of 13 cents per ETF times 100. That will be $13. We see here the POP, that is the probability of profit, and we said we want the probability of profit to be 93% or more, and what we could potentially lose by executing this trade is $187. So if we click on review and send, we will get a summary. So if we execute this trade, there's an immediate credit of $13 with a potential loss of $191.53. So we're risking about $191.53 to get a profit of $13. Now if we do the maths, that's a risk to reward ratio of about 7% over a 9-day period, which is not bad, because if you annualize that, what it means is that you could potentially get to double your money if you are successful every time you execute this trade over a 1-year period. Now the reality though is that the probability of profit is 93%, which means the probability of profit is very high. But as is the case with all trades and all investments, the market could go crazy during the time of your being in this contract, and you could actually lose money. The beauty though is the total amount you can lose is capped at less than $200. So you're risking $13. Sorry, you're risking less than $200 to make at least $13. Does that make sense? All right, we want to go into another tool. So we're going to look at a free website. It's called Options Profit Calculator, and it will help us to visualize how this trade could go for or against us. Now, because we're entering 3 legs of trades with this strategy, we're going to click on the 3 legs there, and then we will enter the ticker symbol of the asset. The SP500 ticker symbol is SPY, and then we fetch the price. Now the first leg is we want to write or sell an options trade. Now when we go back, we see here what we said we wanted to do was sell 2 units of the 413 strike price that will expire on August 22. So we're writing, we select the option, we go to August 22, and we select the 413 bid. So there we go. Then we change the contract amount to 2. Now the next leg that we want is to buy the 414, which is 1 step above. So we buy the 414 of August 22. So we're going to go for the ask. And then the next leg is we're going to buy the 410. So again, we select the option. We're in August 22. We look for the 410 and we buy, which is the bid. Now, this is where the magic happens. So all you now have to do, remember, we've got 2 contracts of the 413 put that we're selling. We've got 1 contract of the 414 puts that we're buying, and we've got 1 contract of the 410 puts that we're buying. And then drum rolls, we hit calculate and see how this beauty comes to pass. We're probably going to get a credit of $8 for a maximum risk of $192. The maximum return we could get on this transaction is $108, and this is if the ETF gets to $412 or $413 actually just before the expiration. Otherwise, we'll probably be seeing that $8 return, and it says the probability of profit is 92%. So this helps us to realize that if we go back to the SPY chart, as long as SPY trades above $413 up until the expiration date, we should be good. And given that SPY seems to be on an upward trend, the likelihood that it will drop from 427 to 413 within a 5 to 10 day period is pretty slim, which is why the probability of profit is above the 90s. So this helps us to decide, and this is why that probability of profit is really, really important. This helps us to decide whether we can execute this trade and if it's going to work. So what I'm going to commit to you is in subsequent episodes, we will be executing this trade and we will be tracking whether we are actually making money from executing these trades or not. As always, we want to be sure that whatever is being said here is for entertainment purposes only. Nothing here should be construed as financial advice. You need to do your own research. You need to determine what your risk appetite is. And if you're comfortable, then you execute a trade that is worth your while. But as you can see from today's explanation, the broken wing butterfly is a low cost, high probability of profit. So that's it for today. If you found the content of this video useful and educational, please smash that like button. If you've got a question, please leave a comment with your question in the comment section below and we'll be sure to respond. And if you know someone that you think will enjoy this video or find it informative, please share it on your social feed. We're trying to hit 1,000 subscribers, so anyone that comes in, enjoys the video and subscribes is a big win for us. Help us get the YouTube algorithm to spread the word. Thank you for dropping by. Look forward to seeing you in our next episode, where we will be looking at specific trades on the broken wing options trading butterfly strategy, and we will see if it's really worth its onions. Have a lovely day.